Hello, and welcome to the fourth edition of Connolly Network Insights video updates. Today, at the end of the third quarter earnings season, I'm going to be looking at what we can learn from the earnings reports of some of the key players in the pay TV and streaming video space. I'll start with Netflix, the leader in streaming video. Then I'll take a look at the two companies that battled it out for the Fox Entertainment and Sky assets in Europe, namely Disney and Comcast. Then I'll take a look at the biggest provider of pay TV today in the United States, aT&T, and what they're doing with their recent acquisition of Time Warner, now called Warner Media. I'll contrast those results with their competitor in the wireless space, Verizon, who have very much taken a back seat to the whole use of video as far as their business plan. And then finally, I'll wrap up with a view of what's been going on with the big four networking companies that form the basis of my primary research, namely Alphabet, Amazon, Apple, and Facebook, and see what they've been up to. So let's start with Netflix. Netflix, having had a weak quarter in the second quarter of 2018, due to a missed forecast for new subscribers, came back on track, delivering 6 million new subscribers in the third quarter and getting back in the good graces of the street. 5 of those 6 million new subscribers came from international markets and 1 million from the United States. Netflix, for those of you who have been following my videos or reports, do not have, in my opinion, a long-term sustainable offering given their current business model. So I'm going to talk about why I think that's so and what they can do to make changes to be able to do better in the longer term. So Netflix, their story has been one of growth. They have added a huge number of customers. They've done that primarily by migrating from an aggregator of content to a provider of original content that's turned out to be very solid content that a lot of people are interested in watching. Now, that originally content was provided for them by external companies as they started out, people like the BBC and Sony Pictures, and they've been migrating more and more so to internally generated original content. In fact, this year they'll produce about 700 pieces of content for their streaming service. Now, their business model is therefore dominated by the cost of content. Last year, they spent almost 80% of their revenue on generating new content at $8 billion of content spend. And this year, they're expected to spend some $12 or $13 billion of content. The problem with this model is that cost of content, which is never high, in my opinion, never diminishes. Generally, over time, as your business grows, you get to the point where numbers turn in your favor and you get more leverage out of the investment you've made to build up the business. But I just don't see that with their content spend. The bulk of their growth has been international growth, meaning they have a lot more localized content in many more languages than English, and a lot of that content doesn't have the same kind of leverage back into their huge base of 130-some million subscribers around the globe. And it's not only a matter of new content to attract new customers, they have to continually generate new content to retain the customers they have. I mean, no matter how good Game of Thrones or House of Cards is, the Game of Thrones is a whole other issue, and we'll talk about HBO in a later segment. But with House of Cards, even though it's a great show and people really loved it, once you've watched it, you've watched it. And then the consumer's next question is, what have you got for me now? I think the biggest mistake that Netflix have made is they have trained their customers to expect a very low price. So that allowed them to grow aggressively, but at the price per customer they're generating, the revenue per customer, I just don't see that their model gets better as they grow the number of customers, because the cost of content is going to grow proportionally. Now, one of the most encouraging signs in this most recent quarterly report was the fact that they had driven their ASP up by 8%, and I think that's tremendously good news for them. But somehow they have to figure out how to get dramatically more revenue without, breaking their content model and having to spend even more. Now they are experimenting with mobile-only subscriptions and with ultra high-end subscriptions with 4K content, etc. So I think they're trying to figure out what they can do price-wise, but until they successfully figure that out, I think in the long run, they're going to be headed for trouble. Now, they also have headwinds coming from increased competition. So their competition has mainly been YouTube, that a lot of people don't think about. Google don't have to split out the YouTube numbers, but it's generally seen by many analysts that their revenues this year will be somewhere in the $13 billion range, and they'll probably generate earnings of 7 or 8 billion conservatively. So they're a very, very successful provider of stream content. Amazon Prime Video have also been chasing Netflix globally, and they typically undercut them, although many would argue their content is not at the same level, but they're spending more and more as they roll out to more and more subscribers. Bigger news next year is the entry into the stream market of Disney, which is a double whammy. Disney comes in and they pull their contract, their content off of Netflix as their contracts allow. aT&T, with their acquisition of Time Warner, will also roll out a much more aggressive streaming plan. And Apple, although Apple have been very quiet about video lately, have been spending a lot on original content and are primed to roll something out in 2019. So my view, a lot of headwinds ahead for Netflix, but I mean, right now you have to give it to them. They continue to add more and more subs. The street is willing to reward that growth as long as the growth doesn't slow. So next, let's talk about the Walt Disney Company, fresh off of their successful battle for the assets of Fox Entertainment. They had a very, very strong quarter with revenues of $14.3 billion, up 12%, and net income up 33%. Disney have been a content company from the very beginning. They generate world-class content and they provide it to the consuming public through a whole series of distribution channels, whether that be movies, DVDs, broadcast TV, pay-per-view, premium channels, theme parks, merchandise, etc. So their whole notion is prepare very, very successful, unique content and then roll that out through as many means as they can to maximize the value of that content. The two things that their CEO wanted to talk about on the conference call were the Fox Entertainment acquisition and their plans to go direct to consumer. So on the Fox acquisition side, it's very, very complementary to what they already have, looked like a very good fit of content. And I think the most significant thing was they talked about a number of the Fox executives that were being integrated into the Disney organization, and it looked like they were planning to utilize that talent. Now, time will tell personality-wise whether those marriages actually are successful or not, but it looked very much like they were bringing in not only the Fox content, but also the Fox executive and creative talent. So I think it was a very, very good match for them. On the streaming side, they were very, very positive about their plans to go direct to consumer and seem to be making a pretty big bet company-wide that this is the way they want to go. Now, they've already acquired BAMTech from Major League Baseball. They have a 75% interest. This is the engine that drives streaming for many of the streaming players, particularly live streaming, which is much more difficult to do. They're already doing all of the ESPN streaming, Major League Baseball, hockey, etc. And this is a core capability that they need to roll their streaming product out. They launched ESPN Plus 6 months ago, and have already ramped that up to 1 million subs. Now, in my mind, that's clearly a test it and see whether they can ramp this thing and keep the customer service levels up and do the marketing, the support. It's very, very complementary to the existing ESPN service, which in spite of the growth pressures and people dropping, is still very much a cash cow for Disney, and ESPN is a jewel in the pay TV crown. So they don't want to upset that apple cart, but the ESPN content is very, very much complementary, pulling in different subsets of people that have a strong interest in smaller pockets of content, like cricket or particular teams in college baseball or basketball or football, etc. And it looks like it's been very successful for them. Although, like BAMTech, they're still in the investment phase, and both of those entities are losing money. They also talked about their mainline streaming service, which they revealed would be named Disney Plus, and they intend to launch that sometime in the latter part of 2019. And it will provide all of the major segments of the unique Disney content plus Fox content to users, so that they think they can get a very, very broad sign up of that capability. And they've indicated a number of times they intend to price themselves below Netflix. So that seems to be their mainline streaming capability for classic Disney content. For adult content, it looks like Hulu will be the vehicle they would use. And that's still an interesting one, because with the Fox acquisition, they are now 60% owner, but you still have Comcast, which owns 30%, and Time Warner, now aT&T, which owns 10%. So the question will be, will those entities want to, or be willing to sell their interests, or will they make it more complex in terms of decision making? So that whole story still needs to play out. But I think it's safe to assume that Hulu will be something that will carry the more mature Disney content, and that will be one of the 3 streaming services that they roll out. So they're building from a very solid position. They're dominating in theatrical movies, very, very strong brand identity with a whole different series of users that follow the various superheroes and classic Disney characters, etc., Star Wars and so on. So it'll be interesting to watch and see how aggressive they are in promoting that when they finally start migrating some of their more mainline ESPN content off of the broadcast capability and into a streamed world, and how they take on Netflix on a global basis. Losing Sky as part of the Fox negotiations definitely didn't help them in terms of launching globally, but I think with the strong Disney brand, they'll still be in a pretty good position to ramp up a global capability. So next we come to Comcast, who are on the losing end of the Fox Entertainment assets, but who won the consolation prize of the Sky customers in Europe. Many say at a very high price or a high premium, but nonetheless they now have a huge customer base in Europe under the Comcast umbrella. So Comcast Results, you know, they were early on believers in the synergy between distribution and content with their acquisition of NBC Universal some years back. Both sides of the company seem to be operating quite well. They're profitable. Higher growth on the NBC Universal side at 8% versus 5% on the traditional Comcast side. About 60% of the revenues from Comcast and 40% from NBC Universal. So when you look at the Comcast side and what they're doing with video, you know, they're one of the bigger players in the traditional pay TV space, and they certainly seem in no hurry whatsoever to do a migration to a stream service. You know, they talked about a pivot in the home to connectivity. So I think for the first time what they've said is, we've been selling the triple play, data as a service we're most interested in, and we're going to continue to reinforce the value of that data. You know, they basically have pretty much built out to 1 gig capability. 70% of their users take 100 meg or higher data service. And they've actually started to talk about video as being in a support role, that they would sell video as part of the whole home capability where it was profitable, but it's certainly no longer on the same footing as the data service. So they've emphasized a lot on Wi-Fi. They have the X-Fi service where they're trying to build a better and better data capability. Similarly with mobility, you know, they jumped into the mobile space. They now have ramped that up to about 1 million users. This is based on an old deal they had with Verizon, where they sold Verizon some spectrum and got the rights to resell their network. So what they haven't done is indicated any willingness to get into the 5G space yet, which would be a major investment for them and a move into a more crowded space. But I think right now wireless seems to be of value to them as an ability to attract new data users and retain the data users in the home that they already have. So where does that leave them then in terms of the value of Sky? Well, Comcast have been very much a domestic company. And I think they've realized long run with players like Netflix global, Disney going global, Amazon global, YouTube global. I mean, they can't continue to be a US-based and focused company and scale the way their competitors will. So they have to do something. So they kind of jumped into the fray. It's a little bit similar to aT&T buying DirecTV because they've kind of bought into a brand new market. It is a satellite-based service primarily, so long-term that satellite has got to go. It's not quite as bad as the DirecTV technology-wise, because the access laws in the UK allow people to gain wholesale rights through somebody else's fiber, so they can use BT fiber, for example, and for the last mile access and run a triple play service over that fiber. But eventually they have to migrate off of that satellite hybrid system that they have now. Now they've already launched Sky, a streaming only lower cost service, but I think the margins in that have got to be significantly lower than the mainline Sky margins. So it'll be a little bit like aT&T's dilemma of going to DirecTV now and taking a much lower revenue point and a much lower margin point as they make the transition. So it'd be interesting to see. Sky is a very strong brand name in Europe, as is Comcast here in the United States, and I'm not sure that they ever mix or that the public will see a benefit from, you know, a Comcast Sky combination in the short run. I mean, they've talked about $500 million of synergy and operating costs, but that's just a finance thing. That's not a value to the customer proposition, particularly given the price that they paid for the Sky assets. So I think you know, we really have to keep an eye on what is it that comes out of the Disney Sky combination that allows them to make the transition from domestic-based provider, you know, big as they are, to a global provider. So can they really get the 1 + 1 = 3 or more as they put those two sets of assets together? So that brings us to the other major player, in fact, the #1 player of pay TV services in the United States, namely aT&T. So aT&T acquired DirecTV some time ago and now have more recently doubled down on video by acquiring the Time Warner assets and having gone through a battle with the Justice Department, which is still actually has an appeal pending, but looks like the whole thing is very likely to continue and won't be derailed by that appeal. So now aT&T is at the point where over 40% of their total revenues are coming from entertainment services. So we think of aT&T as a wireless company that's dabbling in video, but really it's 40% of their company. Very similar to Comcast, 60% traditional and 40% NBC Universal. So aT&T have doubled down with the Time Warner acquisition and hence are very committed to making video successful. Now, unlike Comcast, who are basically saying, hey, we're going to play defense, we're going to continue to let pay TV run as long as it can. And by the way, a lot was said this quarter about over 1 million losses from cord cutting in the pay TV industry. But when you dig into it, you know, 2/3 of those came from the satellite space, from Dish and DirecTV. And Comcast lost about 100,000 users, which is not a great thing, but on the basis of 20-some million users, 100,000 users, which actually was less than last quarter or last year, is really not sky is falling. So the sky may well be showing some signs of storminess, but it's not falling at the same pace for everybody. So back to AT&T, unlike Comcast who are playing defense, AT&T have got to play offense. Their DirecTV service is really under attack right now because the technology just doesn't support the kind of video offerings that customers are looking to have. So they really have to migrate everyone over to a stream service. Now, their plan when they launched the DirecTV Now was an argument saying that if you look at pay TV, it's about equally funded between subscription and advertising. And their view was by using the knowledge of their 100 million plus wireless subs, many of whom are also DirecTV video subs, they would be able to, on a stream basis, implement a targeted advertising campaign in the pay TV space for video ads that would generate significantly more revenue than the traditional pay TV non-targeted ads. So they would shift the ratio much more towards advertising away from subscription, and in fact with a skinny package, give the package away to their best wireless customers and provide it as a perk and generate some targeted advertising revenue to those high-end customers. So, you know, they have to make this change happen because their existing video business, unlike Comcast, is not really stable. It's starting to crumble because of the older technology. Now, to do this shift, they need to have a programmatic video ad capability that they've been busily building and acquiring, but they don't have it ready yet, and I'm sure it's at least probably another year plus away. So, you know, they want to do to the pay TV space what Facebook and Google did to the digital ad space and become the dominant player by putting in a programmatic ad capability and claiming #1 position and then making it the obvious choice for advertisers to flow through their system. So, you know, they're caught between the dilemma of they don't have all the capability built yet. They need to do something quickly because their existing pay TV investment, which was a huge investment, is showing signs of wear and tear. And so they need to get that timing exactly right. Now, fortunately for them, the assets they acquired with the Time Warner acquisition are performing extremely well. It was actually the best part. If you look at it, they for the first time consolidated that part into the business, and it actually performed better than any of AT&T's existing businesses, whether video or wireless or their data, their business customers. And so that's been good for them. Clearly they see a bigger play in streaming for those assets, for HBO. If you think about it, HBO plus Cinemax is about the same size as Netflix, but the key difference is they don't have direct access for the most part, except for the few million that are streaming, to the customer to know what's working, what isn't working, what are the customers' preferences, what are they watching, what do they want to watch, etc. So clearly we'll see a whole Warner Media streaming capability roll out. They're already talked about focusing more efforts around their best assets like HBO. They've already killed 2 streaming services just recently, Drama Feeder, which was Korean language content, and Filmstruck, which was art movie content. So they've killed those, and they seem to be focusing, getting their resources more geared up towards a major battle with Netflix as they launch a service out in 2019. Now, we then look at Verizon, their principal competitor in the wireless space, and what we see is a company there that has really bet everything going forward on 5G. So like aT&T, Verizon dabbled in wireless and never built up very much share, but they built out Fios for a few million homes, and they've already sold a fair bit of that off. They decided, rather than play in the traditional pay TV, that they would try and take Google and Facebook head on for digital advertising. They acquired a programmatic ad capability when they bought AOL some time back. They joined the Billion User Club with their users of Yahoo and AOL services. They launched a millennial-focused ad-based streaming video capability called Go90 that was really just a complete failure, and they've quietly shut that down after a couple of $1 million of spending. But now they're in the mode where they're really going hell-bent to build the best 5G network, and that's going to put traditional strain on aT&T in terms of timing and investment levels. So if you look back on the year, the street's actually been more kind to Verizon with their stock up about, I think, 30%, and aT&T stock down a bit. So two radically different approaches from the two major wireless players. Remains to be seen. I mean, the 5G investment, tremendous potential for new services and Internet of Things and direct fixed access wireless to the home, autonomous cars, etc. Lots of revenue opportunities, but also a huge investment required to get that going. So I don't think we're going to know the answer to that one for another couple of years. But it's clear that Verizon are the leader in wireless, want to remain the leader. The guy running it now came from Ericsson. They're betting on wireless 100%. And aT&T have to balance, the 40% of their business that's entertainment and taking on people like Netflix and Amazon and Apple and YouTube, and then at the same time investing in 5G. So their balance sheet is already strained a bit from their acquisitions. They're going to have a difficult time, but I think you could summarize it up saying aT&T are trying to be innovative, game changer. Comcast are more defending in pay TV. Verizon are defending in the wireless space. So it's a classic offense or defense, who's going to win. So I'll finish with a look at the big four networking firms and what they had to say about video in their earnings results. Apple actually did not mention video at all, other than to say that the sales of the Apple TV were growing at a good rate. They did say, however, that the number of paid subscriptions for iOS users grew from 270 million the previous quarter to 330 million. So they added 60 million new paid subscriptions. Now they do take a piece of some of the video when you subscribe, for example, to streaming services via iTunes, or via the App Store rather, and they cut off 15%. But no questions asked and nothing said about their video offering yet. In my opinion, Apple are very cautious entering a space before they can see a long-term view to solid profitability. So the fact that they haven't said much about streaming video lately, a lot was made when they put up their $1 billion content fund and signed some deals with very big deal people in the entertainment industry like Steven Spielberg. But very little to be said about video from Apple. YouTube featured a fair bit in Alphabet's conference call. They don't strip out YouTube because they don't have to, but it's clearly a very big and growing and profitable service. They pushed again at the World Series their YouTube TV capability as principal sponsor. You could not look at it at any shot without seeing a YouTube TV ad somewhere, whether it was behind the plate or in the batter's box or in the coach's dugout. So they push very hard on their YouTube TV, but again, they haven't given too much guidance in terms of how that's doing. Facebook have been reeling from all of their privacy things, but they very interestingly launched a video-based communications device called Portal in the home, and the capability that they have is that the camera zooms and follows you, so that it's very easy for groups of people to communicate. It's got surprisingly good capability, but with the whole privacy thing, I'm not sure how many consumers are going to want to put a Facebook camera into their living room. So time will tell on that one. They've also been pushing pretty hard on Facebook Watch, which is their entree into the pay TV space with unique content. They've started to advertise content they've had created for them. It's initially all ad-based, no subscription service. But again, I think Facebook's hands are somewhat tied because of the limits in terms of public perception of them due to privacy and the pounding they've been taking over the conduct and their treatment of consumers' data. Amazon continued to emphasize the growth of their Amazon Prime Video service. They have done a deal with Comcast to integrate that capability into the X1 set-top box. They've acquired rights to Thursday Night Football for the season. They're rolling that out, promoting it aggressively. And they're putting up some high-profile original content with people like Julia Roberts. So they don't break out their numbers separately, but clearly between Alexa and what can be done in the home and their Amazon Prime Video and their devices like Fire Stick, they continue to use video as a means of promoting the overall value of their Amazon Prime membership. And so, so again, I think they continue to be disruptive, and they are playing globally. They're underpricing Netflix, and I think will continue to be a formidable player in the streaming video space. So that wraps up this edition. What we're seeing is a number of the major players taking either offensive or defensive positions. A lot of M&A activity ongoing, globalization as a trend, movement to stream services as a trend, concerns about margins and margin pressure as a trend, personalization as a trend. And I think 2019, when we see the ramp up of these new services from Disney, from Warner Media, from Apple, will be the telling point in terms of the shift that's ongoing to IP video, and whether the overall marketplace will continue to be a profitable and healthy one for the players, or whether there'll be a shakeout as the overall environment gets tougher and tougher, and profitability becomes more difficult. So a very interesting year coming up. Stay tuned, and I'll talk to you soon.